Now it's like I don't know what to do with the bond market. And I used to know it well, and like I said, I'm trying again. We'll see if, and I'm worried though that this signals from gold are scary, and what we're going to see. And the thing is, what Trump's doing by battling the Fed so openly like this is every time I see him do that, I just think the gold market just smiles and says, "Thank you very much."
You know, in general, you don't see long periods of time where gold goes up to and making new all-time highs and the stock market continues. That they usually, like, they can travel short periods of time together, but it doesn't usually last. One of those breaks, and I think we're all in agreement that at some point probably the stock market breaks.
Markets are once again moving into dangerous territory, where rising gold prices and euphoric stock market highs collide with policy decisions that are increasingly dictated by politics rather than economic reality. Inflation data may come in slightly hotter or slightly cooler, jobless claims may spike or dip, but the underlying dynamic is clear. The system is running on expectations of Fed easing. Investors are front-running rate cuts, pushing risk assets to records while ignoring the longer-term risks of debt, malinvestment, and weakening fundamentals. Historically, gold surging to new highs alongside stocks is a temporary phenomenon. At some point, one of them gives way, and history suggests it's usually the stock market that breaks. MikeMcGlone, senior commodity strategist at Bloomberg Intelligence, points out that the bond market and gold are flashing warnings that should not be ignored. Meanwhile, Gareth Soloway, chief market strategist at Verified Investing, emphasizes the structural risks in equities and the dollar, noting that current trends mirror setups before major downturns. Together, they highlight how market complacency, elevated valuations, and reliance on Fed support have created a precarious backdrop. What we're witnessing is not sustainable. Record stock valuations against GDP, growing unemployment signals, and a gold market that continues to act as a vote of no confidence in monetary policy. The so-called wealth effect cannot last forever, and when the stock market eventually falters, the fallout will ripple across currencies, bonds, and commodities. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. And enjoy the video.
I guess we talk first about the S&P. S&P, another all-time high today. The party never ends. Today we got CPI. It was a little hot, but then the market looked at the jobless claims, which a lot more people were filing for unemployment. But then the market said, oh, wait a minute, maybe the Fed will cut 50 basis points now, and so markets go up, right? Yields go down. We saw the 10-year lower today, and markets go up. Mike, why don't you make some sense of this for us? Tell me what I need to know.
Yeah, well, they're not going to cut 50, unfortunately. But I think that's the point we're at now. Is yes, record highs in most risk assets, particularly S&P. But we're basically guaranteed to cut 25. But I think we're at that stage now. The market might be entering a little bit of the dopamine stage where it absolutely has to need those cuts. And there's a few little charts I can show real quick, but just let me show you one. This is a chart of Fed fund futures in 1 year. What's the expectation? So we're going to be at 3% a year from now once we start averaging the effective rate for Fed funds in September of 2026. It's already priced in. And that's what I show in this little orange chart. It's 3%. The last time we had this type of situation, this is just the actual Fed's funds rate. This is where futures says they're going to go, was back in right before the financial crisis. Went from 5%, dropped down to 2%. And the big difference then was the stock market to GDP, market cap to GDP was about 1 point times. Now it's 2.3 times. So here's the point is we're so dependent on Fed easing. We're so expecting the Fed easing. We so need the Fed easing that it better come. In the stock market, the question is it front running this? And that's coming, are we going to need more to keep it lofty? But right now, the key risk is we're front running as we head towards that time of year we typically volatility picks up. And it hasn't yet. It's wonderful that we have that VIX at 14.8 and the average, the 200-day moving average is 19.2. So
we're going to get a cut, and markets are pricing in 3 rate cuts into year end. Scott, are you believing that these will all come to pass? Or, I mean, does inflation even matter? Or is the Fed kind of just accepting 3% is the new versus 2%? This is the new normal.
And the employment rate is already starting to tick up. I wanted to show you that one simple little chart on the employment rate, and that is, that's right here. This is the unemployment rate. It looks like it's starting a little bit of a bull flag pattern, but I overlay it with the gold to S&P 5 ratio. they always have reverted to about 1-to-1 gold versus S&P 500 and 6% unemployment. Yeah, now our viewers and listeners will say, yes, we said this a year ago. That's what I'm worried about, is the delayed reaction. And the question is, does this process get started as we head to fourth quarter, which means we're going to get a new chairman, a new Fed chairman next year. And if they do start cutting like you suggested, will, because they have to, because once you get to that position, to that level, you don't want to go down in history as your name is mud.
But so looking back at the inflation numbers, we've seen, basically a slight uptick, except for the PPI number, which magically was a negative number, right?
Yeah.
But you said for a long time you do think deflation will come, but how does deflation come until the stock market pulls back? Because the wealth effect, I mean, at this astronomical move, like, I just can't imagine that people are going to be pulling back as consumers. Listen, there are certain groups in the US that aren't invested and they are suffering. I mean, I absolutely understand that, but the spending is coming from people that have large investments in the market, and that just keeps going up.
So I'll end with that. I'll address that and then tilt over to Scott. This is part of what always has happened. First of all, we're seeing deflation in China, significant deflation, 1.8% 10-year note. That's where I think we're going. But it's the number one thing I've been wrong about, is that U.S. bond market eventually kicking in. And maybe it's getting started. The 10-year yield's at 4% right now. Last year it ended about 4.5%. Maybe it's finally ticked down, but there's one key factor holding everything back, and that's the U.S. stock market. So I have two measures. This is U.S. stock market versus GDP, 2.2 times. Same scale is the U.S. stock the S&P 500 versus the MSCI ex-US index. They're both about 2.3 times versus 14 years ago, they're 1-to-1. That is the number one source for deflation. And I also overlay that with gold divided by the T-bond market. T-bonds, treasuries in the U.S. are the cheapest in almost 40 years versus gold. And for this little reversion, which I've been calling for, and I've been wrong, for that T-bond to drop to, but 4.64 is the treasury, it's to drop to 3 or so, it's going to need the stock market to just go down and have a normal reversion. That's the key thing I'm worried about. What triggers that? And right now, everything's all bullish and fine, but that's where I think gold's telling us something's going wrong. Gold this year is up almost 40%. The last year was up that much, was 1979, and CPI was running 10%.
Gotcha. All right. So, wow. So you're looking at a weakening of the U.S. economy, which is going to force rates down. That's going to then eventually bring the market. I guess when the economy weakens enough, it brings the stock market down, which then makes the consumer pull back enough to trigger deflation. One thing, I want to show you guys this, because I think you guys will find this interesting. But if we look at the dollar chart, and I've been following the dollar and doing more and more research on the dollar, we can see on the U.S. dollar, this is the Dixie, the DXY, right? So it's against a basket of currencies. But there was this trend line going back to 2023 that was holding it up. Look at how many times we bounced off of it. And then recently we broke it, and now it's become resistance, right? But what's even more interesting on the US dollar is that you have a trend line that goes back to 2008, so right at the beginning of the financial crisis, and that's been holding the dollar up the whole way, and we're right back there. And part of me wonders if at some point here we break this trend line, and does that let the dollar move sharply lower over the next, let's say, few years? And again, Mike, I'd actually be curious about are you viewing the dollar? So a dollar's usually a safe haven asset, but do you think that continues here over the next few years, or does it not become the same safe haven it was?
It's such a unique space, because typically, first of all, let's start with what's extraordinarily unprecedentedly bullish for the dollar, and that's what's happening with crypto dollars and stable coins that Trump administration 1.0 didn't figure out, but Trump administration 2.0 figured out, and now the world's shifting towards. It's happening organically. We talked about this years ago, that you cannot, just think of the rest of the world, Russia and China and every other country that hates the dollar. It's like, oh my gosh, there's nothing we can do to stop this. We got to create our own CBDCs. The whole world is going organically to dollar through cryptos. And it's right now only about 300 billion. I could agree with Scott Besson. That trend's going to continue, and it's going to add a zero in the next, who knows how many 5 years, because it's just a better way to hold, transact, and transmit dollars instantly via stablecoins. And once they figure out how you can actually get returns on that, that's a very bullish factor for the dollar globally, and they just can't keep up. But the bearish factor is that chart you showed me, I can overlay the same exact chart. It looks like if you take the S&P 500 divided by the rest of the world stock market, the MSCI US index, they've both corrected to support. They're doing the exact same thing. So the bottom line is that what's really been coincident with dollar strength since the low in 2009 is the US stock market outperforming the world. So that's the risk, I think, for the dollar. But overall, what does our administration want? They don't say it, but if you want want to rebalance trade. A weak dollar is just, you can't do it without a weaker dollar.
A market dynamic that feels increasingly unstable, gold climbing toward record highs while stocks also push into uncharted territory. History shows that this coexistence rarely lasts long, as one asset class ultimately gives way to the other. Current conditions suggest that equity markets are living on borrowed time, driven by speculative momentum and the assumption that the Federal Reserve will continue to provide easy money through rate cuts. The bond market, however, appears less convinced, sending signals that align more with gold's warnings than with the optimism embedded in equities. Layered into this market tension is the political backdrop, where open clashes over monetary policy further erode confidence. Each time the Fed's independence is challenged, gold strengthens as investors quietly hedge against instability. Meanwhile, the divergence between real economic signals, like rising unemployment claims, and inflated asset prices grows sharper. This creates a widening gap between financial markets and underlying fundamentals, a gap that historically closes abruptly rather than gradually. The atmosphere resembles past moments before corrections, with volatility compressed and complacency at dangerous highs. Let's get back to the interview.
The Bitcoin gold cross. This is a chart I've been worried about for a while because it's showing me the divergence that I'm supposed to look for as a strategist. You need to look for inflection points, look ahead of the market. It's the same right now as it first traded in 2021. Now, Dave Weisberger always likes to push back on this. But again, it's the same chart syndrome with the U.S. stock market GDP. That's the wealth creation effect. And the way I look at this is a commodity traders, you want to sell at the upper end of the range. This is when President Trump got elected. We got another test near 31 and the Bitcoin gold cross. And you want to look for dips to buy. Why shouldn't it go back to 25 and just a normal rotation? To me, this is what might be happening in the fourth quarter. That's why I think the next few months are going to be so telling. Now, if we can stay at these levels and continue with low volatility and continue to appreciate as the Fed starts to cut rates and the economy, the labor market slows down for the recession most of us expected 2 years ago, we never got, that would be wonderful. I look at it just a trading range. You were supposed to be selling cryptos or Bitcoin versus gold a few months ago, and you should be waiting a while to be buying.
Can I ask you guys a question about AI and its impact? So Oracle reported earnings. The stock went up the most a large cap has ever gone up in one single day. From a $700 billion company, it went up as much as 42% intraday, closed up like 36%. But like, you know, I'm kind of starting to see this future where more and more jobs are replaced, like these lower paying jobs. And is that some vision that you guys are seeing as well, is where the unemployment rate starts to go up substantially and the diversity between really rich, like people that are either AI programmers or people that own it, they just get like, I mean, trillion, like Elon Musk just got proposed his next pay package is going to make him a trillionaire, right? But then you have people that were working at McDonald's, which are going to be replaced by robots. And I mean, is that something that you guys are seeing? And number two is, is this enough to keep the economy, or like, what's the impact on the economy? Is it good or bad?
To some extent, I think a lot of that's true. It's certainly showing up with new college grads. They're having the unemployment's high. I think it's really enhancing the value of the trades. I mean, I don't know if an AI can do plumbing and electrical value. So, well, there you go. The robots creating their robots. I just listened to a great podcast on All In with Elon Musk talking about the dexterity of creating a humanoid type robots. I mean, it's coming. It's happening fast, but it's going to be a while. The key thing I want to point out is we all knew what would happen, and we all expected the internet to change the world, and we all knew, back then, a lot of us knew these things I was trading, like I did some cryptos, were just silly, and you had to just trade them for fun. Once you doubled your money, take some profits. And we had the major flush, the correction, and now we can't live without the internet. I think that's going to happen in the AI, and that's the point I want to point out when I show you in the charts. When you get 2 times the GDP in the stock market, only 2 times that's happened in history, 1989 in Japan, in 1929 US, you got to be looking for alternatives. Maybe it's different. Maybe it can last a little longer, but this is only the first year it's done it. And that's why I keep looking for alternatives like gold. So my point is, that's a lot of that's priced in the equity markets, just like people have made the example of the railroad stocks. Some of them peaked in the 1900s, and some electricity stocks peaked then too. Because the revolution, a lot of it's priced in. We do have the Mag 7, and the question is now how further does it go? Can we get through this period? First of all, can we get through 4 years of a Trump administration without a normal 20% stock market correction that stays down? I think it's very unlikely. You've only had 19% and went poof and went right back up. So to me, that's what I'm looking forward to, is at some point we're going to get this normal reversion in elevated risk assets pricing and how wonderful AI is. And then we're going to get the reality of, sure, it's going to eliminate jobs for a while. It's going to crush inflation, just like all technology does, which is probably why I'm still bullish bonds. Been wrong. And then we'll get to the point where we're going to look back from the future and say, after all the dust settles, and we'll be fine. But I stick with my call that I've been way wrong on it. I think we're overdue for another 50% drawdown in U.S. stocks, only because they're way too expensive. I'm just waiting for the timing. And so far I've been wrong.
And they get more expensive. I mean, incredible that move on Oracle. I mean, if you had told me the day before that a company could miss earnings, miss on revenues, they missed on both the metrics. But then, think about how silly this environment is. The company was like, oh, but don't worry, guys. Like over the next 5 years, we're going to do so well. We're going to, to quote our president, it's going to be the best ever. Right. And then the market's like, oh, yeah, they missed on earnings and revenue, but let's believe them on this and push up the stock, $300 billion. Right. I mean, it's just so ludicrous.
What's the best way to make a market go down is squeeze the shorts. And that sounds to me like a pretty good short squeeze.
Well, and not only that, but Scott, something we talked about in the last few market mavericks. Have you seen how many of these stocks are repeating what whatever immersion technologies did? I mean, it's incredible. Let me show you guys some of these. It was, what was it? QMMM, this thing, 2,700% move. They said they were going to buy some Bitcoin, Ethereum, and Solana. CWD gapped up, went up 2,400% intraday. They said, "Oh, we're going to buy some Chainlink and make it into our treasury." I mean, this stuff is ridiculous.
Pulp strategy.
We have next week's Fed decision. I think, are we all agreeing there will be a rate cut of 25 basis points?
Yeah. Yes. That's priced in, and then my Bloomberg terminal shows 100%. Doesn't really show anything more than that. What do we have? 107%. It's just 25. But it does show. I like to point out, if you get out to SEP 2026, we're already down below 3%. To me, that's the key thing, that the market's already pricing in that easing. It's pricing in that fuel. If we don't get it, that's a problem. And if we get more than that, it might be because the market's telling you you need more. But that's what the market expects. I mean, but for the meeting in September for next week, 25 basis points, 106%. So it's not far enough.
Do you guys think that? So there's people talk when Powell talks, people say Powell will speak hawkishly or dovishly, right? So they're going to cut, which is a little dovish. But do you think he's going to be more dovish? Will the market say, "Oh, this is good news"?
No, it's like, I don't know what to do with the bond market. I used to know it well, and like I said, I'm trying again. We'll see and I'm worried though that this signals from gold are scary, and what we're going to see. And the thing is, what Trump's doing by battling the Fed so openly like this is, every time I see him do that, I just think the gold market just smiles and says, "Thank you very much."
In general, you don't see long periods of time where gold goes up to and making new all-time highs, and the stock market continues. That they usually, they can travel short periods of time together, but it doesn't usually last. One of those breaks, and I think we're all in agreement that at some point probably the stock market breaks.
The financial landscape is moving into a stage where confidence is fragile, and gold's ascent is no coincidence. Central banks are quietly shifting their reserves, investors are rethinking the safety of fiat currencies, and economic revisions are exposing weaknesses that were previously glossed over. Each of these factors points toward a world where trust is eroding. Gold, silver, and even platinum are stepping into that role, while traditional markets struggle to maintain their narrative of strength. This moment is not simply about price charts. It's about the underlying story of credibility. Jobs data revisions, questions over inflation reporting, and political interference are all symptoms of a system under pressure. History tells us that when confidence wavers, change happens fast. We're witnessing a shift that could redefine how investors protect their wealth in the years ahead. Gold is not just responding to rates or inflation. It's responding to a more profound unease about the system itself, and that's why it continues to command attention. Share your thoughts on their analysis in the comments section below. If you find this video informative, please Please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.